Welcome back to the deep dive. So we're digging into a set of numbers today that, they just don't add up on the surface. I had read them twice this morning.
It's a classic case of what you'd call headline dissonance, isn't it?
It really is. Because if I just give you the big splashy number, assets under management hit $1.78 trillion, you'd think T. Rowe Price is, just absolutely crushing it.
And that is a massive number. It's near a record for them.
But then you scroll down, you get past the bold print, and you see this other number. Clients actually pulled out almost $57 billion in cash in 2025, it feels like. Like you're feeling a bathtub with the drain wide open.
But the water level is rising anyway.
Exactly, because the water itself is somehow expanding.
It's actually a shockingly good metaphor for how a bull market works. The water, the stock prices, they expanded. And that completely masked the fact that real volume, real cash was draining away.
Okay, so that's the puzzle we're tackling today. We're breaking down T. Rowe Price Group's fourth quarter 2025 earnings. They just dropped this morning, Wednesday, February 4th, 2026. We've got the earnings call transcript, the slide deck, all of it.
And the market backdrop for this is just chaotic.
It's wild. My newsfeed today is flashing Palantir crushing earnings. There's chatter about Pelosi's bullish 2026 buy list, fears of a market crash. It is all noise and AI hype.
And right in the middle of all that, you have this very traditional, very conservative, Baltimore-based asset manager, a firm that's been around since the Great Depression.
So the real question isn't just, did they miss earnings by 2 cents? It's more existential.
Sure.
It's, does a company built on old-school stock picking even have a place in this new world?
It feels like an identity crisis playing out in a financial report.
It does. So our mission today is to figure out how this massive tanker is trying to turn. Because looking at this report, they are throwing everything they have at the problem. We're talking ETFs, private credit, global partnerships, and even, we'll get to the crypto surprise in a bit.
We definitely will. But yeah, the mission is to analyze that pivot. Can they move fast enough to stop the bleeding?
All right, let's do it. Section 1, the earnings paradox. Let's just get the numbers out on the table. How did Wall Street grade this quarter?
It was a mixed bag, leaning a little disappointing on the profit side. They reported adjusted earnings per share of $2.44.
Which was a miss, right?
A tiny one. By exactly 2 cents, the consensus was $2.46. But on the other hand, revenue, the actual money coming in, that was a beat. They brought in $1.93 billion, which was about $10 million more than expected.
So a little more in sales, a little less in profit. But let's go back to that number, that illusion of growth. Assets up over 10% year over year. If I'm just a casual shareholder, why isn't that great news?
Because you always have to ask why the assets are up. And in this business, there are only 2 ways to grow. 1, you get new customers to give you their money.
Right, new inflows.
Or 2, the stock market goes up. And the money you already manage just becomes worth more. T. Rowe's growth was almost entirely option 2.
So they were just riding the market wave.
Completely. They were riding the wave while clients were actually, getting off the surfboard. In the fourth quarter alone, net outflows were $25.5 billion.
$25 billion more taken out than put in.
In just 3 months. And for the full year, it was almost $60 billion.
That is a staggering amount of money walking out the door. So what's the excuse? I saw the CEO, Rob Sharps. He has a specific phrase he used. He blamed the narrow market.
The narrow market, we hear it all the time.
We do, but what does it actually mean for a fund manager day to day?
It all comes down to the math of an index like the S&P 500. When you hear the market is up, what that's really meant for the past year is that 5 or 6 giant tech companies are way, way up. The Palantirs, the Nvidias of the world.
The Magnificent Seven or whatever the new name is this week.
Exactly. And a firm like T. Rowe Price, they're fundamental stock pickers. They look at valuations, at price-to-earnings ratios, and to them, a lot of these huge tech stocks look wildly expensive.
So they don't buy them, or they underweight them.
Right. A T. Rowe manager says, I can't justify buying Nvidia at this price, so I'm going to buy this, undervalued industrial company instead. It sounds prudent.
And normally it would be.
But not now. Not when Nvidia doubles in a year and that industrial company just stays flat. The T. Rowe fund underperforms the index.
And then the client sees their statement, compares it to the S&P, and says, why am I paying you for this?
That's the trap. That is the narrow market trap. And it snaps shut on almost every active manager in 2025.
So the core product, the mutual fund that built this entire company, is bleeding cash. $64 billion left their mutual funds last year. So clearly, they have to do something else. This brings us to Section 2, the pivot. Where's the money going, and how are they trying to catch it?
They're sprinting towards ETFs, exchange-traded funds.
Which, I have to say, feels like showing up to a party that started 15 years ago. I mean, haven't Vanguard and BlackRock already eaten all the good appetizers?
They are late. There is no question they are late. But they're trying to find their own little corner of the room. They're not trying to be Vanguard and offer a super cheap index fund. Their strategy is what they call active core ETFs.
Okay, so what's the difference?
A standard ETF is basically a robot. It just buys a list of stocks to copy an index. T. Rowe's active core ETFs still have a human manager. Their research team is still trying to pick stocks to beat the market.
So it's the same brain, just in a different, more modern package.
A package that's cheaper, more tax efficient, and that younger investors actually want to buy. And you know what? It's starting to get some traction. They launched 13 new ETFs in 2025 alone.
And how much money is in them now?
There are over $21 billion in ETF assets. It's a start.
21 billion is not nothing. But speaking of modern packages, we have to talk about the real curveball in this report. The thing that actually made me go, wait, what? T. Rowe Price is getting into crypto.
It just leaks off the page, doesn't it? This conservative, buttoned-up firm has registered an active crypto ETF with the SEC.
Is this an act of desperation? It feels a little like your grandpa suddenly getting a TikTok account.
There's definitely a bit of that how do you do fellow kids energy to it. I won't deny that. But if you look closer at the details, it's pretty interesting. It's slated for a 2026 launch, and it is not just a let's buy and hold Bitcoin fund.
Okay.
They're calling it a multi-token approach using both fundamental and quantitative analysis.
So they're not trading dog coins. They're trying to apply their big data brain to the crypto market.
That's the bet. They're betting crypto is becoming a real analyzable asset class and that they can find an edge with research, not just with hype. It tells you they're terrified of being irrelevant to the next generation.
They should be. I mean, the mobile native investor is not calling a broker to buy a mutual fund. If T. Rowe doesn't have a product on that digital shelf, they basically don't exist to anyone under 40.
Precisely. So you have this digital frontier on one side, but then you have this other very opaque world, private markets. That was the one real bright spot in the report.
Right. Section 3, the new frontier. While all the stock funds were bleeding cash, the alternatives bucket actually had positive inflows.
And this is almost entirely the story of a company they bought a few years ago called O'Shea, or Oak Hill Advisors. That acquisition is looking smarter every quarter. They raised over $16 billion in 2025.
Mostly in something called private credit. We hear this term a lot. Break it down for us. Why aren't companies just going to a normal bank for a loan anymore?
That's the key. After the banking turmoil a few years ago, regulators came down hard on the big banks. They basically said, you need to hold more capital, you need to take less risk. So the banks pulled back.
Creating a vacuum.
A huge vacuum. And OSHA stepped right in. So if you're say a medium-sized software company and you need $500 million for an acquisition, JP Morgan might say no. OSHA says, sure, we'll give you the loan, but it's going to cost you 11% interest.
So it's higher risk, but a much, much higher reward.
And institutional investors, like pension funds, are absolutely desperate for that kind of yield right now. So T. Rowe, through OSHA, is effectively becoming a bank for companies that are too risky for the actual banks.
It's like moving from the public casino floor to a private, high-stakes lending room. Which brings us to another buzzword, tokenization. Eric Vail, their head of global investments, talked about this. He broke it down into 3 parts: efficiency, product, and distribution.
And that product piece is the really revolutionary part. He's talking about fractionalization.
Okay, plain English, what is that?
Well, let's stick with that private credit fund. Historically, to invest in a fund like that, the minimum check you'd have to write might be $5 million, maybe $10 million. It's a club for the ultra-rich.
So 99.9% of people are locked out.
Completely. But if you tokenize that fund, you can digitally slice that $10 million ticket into, say, 1 million tiny digital tokens. All of a sudden, you can sell a piece of that exclusive high-yield fund for $1,000 on a smartphone app.
You're democratizing the VIP room.
That's the holy grail. It opens up this entire world of alternative investments to a much broader audience, and that's a massive potential market.
But to sell to that market, you need reach. You need shelf space, which leads perfectly into Section 4, the partnerships. Because the old T. Rowe Price was an island. We build it, we sell it, we control it. That era is clearly over.
Oh, that island has sunk. They're building bridges now, and the biggest one is with Goldman Sachs.
A co-development partnership. What does that actually mean?
It's an ingredient strategy.
Intel inside.
Exactly like Intel Inside for computers. Goldman Sachs has the powerful brand and the distribution platform. They have relationships with thousands of advisors. T. Rowe is providing the intel, the actual investment models that go inside the Goldman-branded product.
So an advisor at, say, Morgan Stanley can now offer their client a Goldman Sachs T. Rowe price retirement portfolio.
And T. Rowe gets their product in front of eyeballs they could never have reached on their own. And they just did it again. They announced a new strategic partnership with First Abu Dhabi Bank in January.
So they're pushing into the Middle East.
It's an admission of humility, really. They know they can't build a sales force in Dubai from scratch. It would take a decade. So instead, they partner with the biggest bank in the region and get on their shelves tomorrow.
It's choosing speed over absolute control. It's adapt or die. Okay, let's bring this back home to something that probably affects a lot of our listeners directly. Section 5, the battle for retirement, and specifically target date funds.
Yeah, the set it and forget it 401k option. This is T. Rowe's fortress. We're talking $560 billion in these funds alone.
But even the fortress walls were breached a little in Q4. They saw outflows, money leaving, and the reason they gave was M&A, mergers and acquisitions. How does that work?
It's a brutal game of corporate musical chairs. So imagine you work at a company and your 401k is with T. Rowe Price. Everything's fine. But then your company gets acquired by some giant corporation that uses, say, Fidelity for their plan.
All the 401k plans get consolidated.
T. Rowe gets the boot, not because their performance was bad, but just because the new parent company uses a different provider. And with all the M&A activity last year, they lost a few of those big corporate plans.
That's a tough break. But there's a deeper, more structural shift happening here too, isn't there? This move away from fully active funds.
This is probably the single most important trend for the average retirement saver to understand. Historically, a T. Rowe target date fund was fully active. That meant every single piece of it, the U.S. stocks, the international stocks, the bonds, was managed by a human trying to beat the market.
And that's expensive. You're paying for all those managers.
Very expensive. The market is now demanding hybrid or blend funds. Think of it like making a cocktail.
Okay, I'm with you.
The fully active fund is where you use the top shelf $100 a bottle gin for your G&T. Even the tonic is some artisanal small batch brand. It's a fantastic drink, but it costs you $25.
And the hybrid model.
The hybrid model says, you know what? For the gin, which is like the S&P 500 part of the portfolio, let's just use the perfectly good, inexpensive index fund, the rail gin.
Because it's really hard to beat that index anyway.
Exactly. But, the hybrid model says, for the really complex parts where a specialist can add value, the emerging market debt, the high-yield bonds, let's keep using the expensive top-shelf stuff there.
So you get a drink that's 95% as good for half the price.
That's the hybrid promise. And T. Rowe is gaining market share in that space, but they make a lot less money on it. They're basically having to cannibalize their own high-fee business just to keep the client.
Trading dollars for dimes to stay in the game.
Yeah.
And that must cost money. Which brings us to our last section, Section 6, the costs of transformation.
It is not cheap. Their guidance for 2026 is that operating expenses are going to rise another 3 to 6%. And they just took a huge one-time restructuring charge in the fourth quarter, almost $150 million.
What's in a charge that big?
A lot of it is real estate write-downs, empty office space in a work-from-home world.
In severance.
And severance, yes. They are cutting heads in the legacy parts of the business.
So they're firing old-school stock analysts.
To free up money to hire expensive crypto quants and tokenization engineers, they are reallocating their budget from people to technology.
That sounds painful.
Yeah.
And yet, when you look at their balance sheet, they are not hurting for cash.
Far from it. That's the central paradox here. Despite all these challenges, the outflows, the identity crisis, the company is a cash-generating machine. They returned $1.8 billion to shareholders last year.
And they raised the dividend again.
For the 39th consecutive year, they have zero debt. They are incredibly profitable. They're just not growing.
A very profitable, slowly melting ice cube.
That is the big fear for investors, yes.
So let's try and tie this all together. We've got the paradox of assets versus flows, the narrow market trap, the big pivot into ETFs, crypto, private markets. What's the final synthesis here?
The synthesis is that T. Rowe Price is doing all the right things strategically, but they are fighting against a powerful tide. They are planting these new seeds in ETFs, in private credit, with OSHA, in partnerships. Those are good moves. But the big old legacy tree, the active mutual fund business, is shedding leaves faster than those new seedlings can grow into trees.
It's a race against their own legacy.
It is. And for you, the listener, even if you don't own a single share of TRW stock, this is important. This whole story signals the definitive end of an era, the era of the star stock picker being the default for your retirement account.
What do you mean by that?
I mean, if T. Rowe Price, the gold standard of our smart people can beat the market, is aggressively moving to hybrid models, launching passive ETFs, and buying private lending firms, they're admitting that for the average person's core portfolio, the old-school stock-picking game is over.
So my 401k is just becoming a passive, automated machine.
It's becoming more passive, more blended, and it's also starting to include complex assets you can't even see, like those private loans. You're shifting from being an investor in companies to an allocator across asset classes.
That is a really profound shift. Which leaves me with a final thought for everyone to chew on. We're seeing T. Rowe Price launch a crypto ETF. We're seeing them become an ingredient for a Goldman Sachs product. So are we watching the death of the independent conservative asset manager, or is this just what survival looks like in 2026?
In a world dominated by trillion-dollar index providers and tech platforms, maybe true independence is a luxury that no one, not even a firm with $1 trillion, can afford anymore. It's a scale or fail world now.
Scale or fail. A sobering thought to end on. Go check your 401k allocations, see if you're drinking the top shelf cocktail or the hybrid, and we will catch you on the next deep dive.
Thanks for listening.